Is housing headed for another 2008? I think it could actually be worse. During the last week of June 2025, mortgage rates hovered just below 7%. The national median home price still sits above $400,000, and inventory is up but nowhere near healthy. One shocking statistic I saw was the median age for first-time homebuyers in the United States in 2025 is 38 years old. This is an all-time high and a 3-year increase compared to July of 2023, according to CNBC. The overall median age of all homebuyers, including repeat buyers, is 56, which is also a record high. The data points you're about to hear could save or make you a small fortune over the next 2 years. First, let's rewind to that infamous crash. Back then, the problem was reckless lending layered on a tidal wave of oversupply. Cheap teaser rates let people buy far more house than they could handle. And when those rates reset, the market buckled. Prices fell 30% nationally, but the cure was obvious. Clear out bad loans and soak up excess homes. In 2009 alone, banks repossessed nearly 1 million properties, and new construction ground almost to a halt, giving demand time to catch up. Fast forward to today, and the culprit isn't sloppy credit. Underwriting standards are tight. The new villain is a toxic cocktail of record high prices and record high borrowing costs that have frozen both buyers and sellers in place. Instead of a wave of fire sale listings like we saw 15 years ago, we now have a market that simply refuses to move. Existing home sales illustrate the freeze. In May of 2025, only 4 million homes change hands on a seasonally adjusted annual basis. That's roughly 25% below the pace we thought of as normal before the pandemic. New home sales aren't rescuing volume either. They're running near 650,000 a year, healthy for builders but nowhere near enough to satisfy the national demand. Pending contracts, which predict future closings, have fallen 19 straight months. The reason is what economists call the lock-in effect. Roughly 2/3 of homeowners refinanced when rates were 3% or less. For them, selling means trading in a payment they know for one that could be 60 or 70% higher. So they stay put and all the transactions slow to a crawl. Rates are the silent killer in this story. The benchmark 30-year fixed loan has averaged 6.5% all month of June. And many borrowers with small down payments or lower credit scores are being quoted north of 7%. That might not sound colossal until you run the math. Borrowing $400,000 at today's rates costs about $900 more per month than it did at the 3% low in 2021. That extra payment alone wipes out the typical first-time buyer's budget. The gap between 10-year Treasury yields and mortgage rates, also known as the spread, has widened to levels we haven't seen since the early 2000s, showing lenders want a fatter cushion against the risk. And because the Federal Reserve keeps signaling that inflation is sticky and rate cuts will be few and far between, the market knows relief isn't coming anytime soon. Now let's talk about supply. Yes, active listings have finally risen, about 31% above last year, but context matters. We're still 14% below the inventory we considered normal back in 2019. Worse, much of the new supply is luxury homes, priced well beyond what the median income can support. Imagine walking into a grocery store where every shelf looks full, only to realize everything costs twice what you can afford. That's our housing market. The National Association of Realtors counts roughly 1.5 million unsold units, or about 4.5 months worth of supply. A balanced market is about 6, so despite the uptick, we remain miles from healthy. And remember the silent inventory. Second homes sitting empty, short-term rentals are struggling with new local regulations, and vacant lots waiting for cheaper construction loans. The result is an affordability crisis that rivals or even beats 2006. The typical mortgage payment now absorbs close to 40% of median household income, a level we haven't seen since the height of the last bubble. For renters, it's not much better. After 4 straight years of double-digit rent growth, tenants face historically high monthly costs, making it almost impossible to save for a down payment. Layer on surging insurance premiums and climate risk zones, higher HOA fees as associations rebuild their depleted reserves, and rising property taxes as local governments chase post-pandemic revenue, and housing now eats a bigger slice of the average budget than at any time in modern memory. So far, tighter lending standards have kept delinquency rates low, but stress is surfacing. Lenders started the foreclosure process on about 24,000 homes in May. That's up 8% from a year earlier. That may sound small next to the millions of filings during the Great Recession, but remember, this increase is happening while unemployment is still under 5%. Early trouble is concentrated in FHA and VA loans, which often carry minimal down payments, and in borrowers who took adjustable rate mortgages at exactly the wrong time. If job losses accelerate or rates stay higher for longer, that trickle of foreclosures could become a dangerous stream. And don't expect home builders to bail us out quickly. Material costs, labor shortages, and higher financing expenses have hammered their margins. The National Association of Home Builders Sentiment Index slid below 45 in June of 2025, one of its worst readings since 2012. Builders are slowing starts and even pause projects mid-construction because demand simply isn't strong enough at today's prices. That means new supply, the most reliable antidote to high prices, won't arrive in meaningful volume until at least 2026. The pain isn't evenly spread. In the Sun Belt, especially Florida and Texas, inventory is piling up while insurance crises have doubled or even tripled homeowners' premiums. Some carriers have exited entire zip codes, making conventional mortgages impossible until borrowers secure costly surplus line coverage. On the West Coast, sellers are slashing prices, but homes remain wildly unaffordable thanks to restrictive zoning, expensive permits, and sky-high land costs. Meanwhile, the Midwest and select Rust Belt cities look downright cheap by comparison, yet even there, the jump in rates has slowed deal flow to a trickle. In the Northeast, property taxes that can top $20,000 a year act as their own form of sticker shock. Beyond housing, several headwinds threaten to turn this freeze into a full-blown storm. Student loan payments resumed last fall, siphoning roughly $300 a month from many millennials, the very cohort that should be driving first-time buyer demand. Corporate layoffs are edging higher in tech, finance, and media, with severance packages that are masking the true hit to disposable income. Credit card and auto loan delinquencies have quietly climbed to multi-year highs, a sign that household budgets are stretched to the brink. And large institutional investors, the same players who scooped up suburban rentals by the thousand, are now unloading properties to shore up liquidity. These bulk sales add supply at the top end of the starter home prices, pushing private buyers even further to the sidelines. Put it all together, in 2025 could sting in a way 2008 never did. Back then, prices collapsed, but rates fell, giving qualified buyers a lifeline. Today, prices remain elevated while financing grows more expensive. Demographically, we have a record number of millennials trying to buy and a record number of baby boomers aging in place, refusing to sell. That tug of war keeps supply tight even as demand weakens, creating the worst of both worlds. So what should you watch out for in the months ahead? Well, first, keep an eye on months of supply figures. If we cross 6 months nationally, price declines are likely to accelerate. Second, monitor early stage delinquencies. A sustained uptick there will foreshadow broader distress. Third, watch cancellation rates among builders. Rising cancellations signal buyers pulling back even before closing day. On the personal front, be conservative. If you must buy, aim for a total housing payment that's no more than 30% of your take-home pay, and preferably fixed for at least the next 10 years. Build a cash buffer covering at least 6 to 12 months of living expenses. If you're an investor, prioritize properties that cash flow from day one, underwrite them at higher cap rates, and use conservative debt service coverage ratios. Stick to markets with diversified employment bases so you're not betting on a single industry to keep tenants paying. I know this has been a gloomy look at the data, but information is power. Markets don't crash everywhere at once or forever. By understanding the forces at work, tight supply, high rates, rising costs, you can position yourself to survive the downturn and seize opportunities on the other side. If you got value out of this video, please hit the subscribe and the like buttons. Also drop me a comment. Let me know if you're looking to buy a home or sell your home and reasons why maybe you're holding back until either rates drop or some other reason. Until next time, thanks again for watching. We'll see you.